I'm going to stick you all on mute for now, just so there's no background noise. Let me figure that out. There we go. Throughout, if you want to, I'll be asking a few questions here and there, but I'll most likely ask you to put them in the chat. Please do put any other questions in the chat that come up. I'll try and check it whilst we're going, but Zoom is a bit awkward when you're sharing screens. So at the very minimum, I'll check them and answer them at the end. And nearly ready. Zoom's just a bit fiddly when you're sharing full screen slides. Trust me on that one. Okay, here we go. Nearly. Just got to get my chat window the exact perfect shape so everything shows just as I need it to. I think that should be about right. So this is what we're going to go through. I'm not going to spend much time here because I sent it out via chat as well. Let's move on. Here's a quick disclaimer. Have a quick read while I'm chatting, but essentially it just says that I don't take responsibility for your investments. This is purely an educational service. If I mention certain strategies or investment types, I'm not saying that you should go and do it. That depends on your personal situation. Investments go up and down. If you do decide to do something and you lose money on it, then that's not my responsibility. But if it makes money, then of course I'm happy to take the plaudits for that. This should be used as a foundation for what happens next. It's very much a beginner's course, although I want to try and make it as practical as possible. It's a fine line because there's absolutely loads I could speak about, and I'll send out a survey at the end so you can let me know if you think I've struck a good balance. But yeah, whatever you choose to do is absolutely your decision afterwards. Away we go. Just have a quick drink of tea. Hopefully you've all got tea, snacks, whatever you're going to need. Okay. So firstly, there's just a very quick clarification that I want to make up front so that we all know what we're talking about here. And that's the difference between trading and investing. And a lot of people get these confused. And actually, I think from talking to people, I've been surveying a lot of friends, family, and Instagram recently, and people get these mixed up. And I actually think it's one of the main reasons why a big group of people don't start investing, because they don't have this right. And that's why it's at first. So trading is very short term. From some people trade literally by the second or by the minute. And investing, we're talking much longer term, so medium to long term. I've put here 1 year plus. Essentially, when you're investing in something, you need to be ready to hold it for a while. And there's different ways of determining what a while means, and we'll talk about that a bit more as we go through. And periodically, I'll just pull up a few things here. When we talk about trading, we're talking about all these fancy lines, all these colors and squiggles and drawings and stuff. And some people sort of see this on screen and get really scared, and you should, because that's absolutely not what we're doing today. Okay, this is trading. Investing is not that. Okay, so the first differential is time horizon. Difficulty, very much related to what I just showed you. Trading is super hard. Takes many years of experience. It's very much professionals that do it for their living. And investing is not. People, again, have a misconception that investing is difficult. because it's a big black box full of acronyms and stuff that you might see on the news about finance and economics and stuff. It's actually not that complex. And what I'm trying to do today really is one of the key goals of this course, is to show you that it's not difficult, because that's how we get more people doing it. And the strategy, trading is all about technicals. When we say technicals, it's charts. It's what I just showed you. People try and determine whether it's going to go up or down in the short term based on what that chart looks like at a very basic level. Very hard to do. Very easy to lose money doing that if you don't know what you're doing. Investing, we don't really care about that. We'll check it every now and again when you invest in something, because obviously it's good to know whether it's going up or down. But what we really care about when we invest is fundamentals. That's a technical term, fundamentals, but again, it's not complicated. All it means is whatever thing that we're investing in, whether it's a company or I've put project here, and by project I also mean things like gold, silver, Bitcoin, etc. It's, do we believe in the fundamental aspects of that asset or that project? If we believe that that asset is valuable to the world, and over time it's going to become even more valuable, then that means at a very basic level, then the fundamentals are good. For a company, the same applies. A company, we might also say, if we want to go a slightly deeper level, does it make profit? And do we think it's going to be more profitable over time? And it doesn't really need to go further than that. If that's the case, then again, at a very high level, it looks like a decent investment. That's a very clear line between those two approaches, trading and investing. And if you're not 100% sure of what we're focusing on here, it's the right hand side, and it's investing. Okay. So why would we invest? Firstly, it is interesting, challenging, and fun if we want it to be. And for me, that's a very important mindset to get your head around, because when you haven't done it before, again, with some of that terminology, the way people talk about it, just the fact we don't know anything about it, it can seem dull, it can seem too complicated, it can seem stressful. And if we look at it that way, then we're probably not going to start. And if we do start, we're probably going to lose interest or just get anxious about it. And that's not what we're aiming for. Everything in life should be exciting. We should enjoy doing it. And one of the things I want to get out today as well is really creating, hopefully, that interest in what's possible. I mentioned empowerment before with the meditation. This came out of a chat we had on last week's course, actually. So I've just added it in, and I thought it was brilliant, the person that mentioned it. The opposite of investing, or not knowing how to invest, is quite disempowering, or actually very disempowering. And I'll go into the reasons why, because if we're not investing properly, then we're losing money, and I'll show you why. Not even just staying neutral. And if we see it as this thing over there that maybe isn't for us, that, you know, people in suits do, they do it in banks, and it's not for me, I don't know how to do it, it's scary, money's bad, economics is bad. It's quite a disempowering mindset to have, because, you know, without getting into economic and monetary policy, you know, this is a large element of the world that we live in, you know, and it's mostly good. Again, I'm not going to go too deep into that, but if we can trade with each other, then that has been responsible for all of the things that we see around us, including the amazing medicine and science and buildings that we live in and stuff like that. So really starting to take interest in this side of things. is empowering. At a very basic level, it means that you're not scared of it anymore, which is a good thing. And then on top of that, taking control of your personal finances to an extent where you are potentially setting yourself up for financial freedom at some point in your life. To me, that's super important. And actually, in the long run, but actually, hopefully, in the short run, it relieves a lot of stress, it relieves a lot of anxiety, and gives us options to do the things that we want to do with our lives. Investing is an opportunity to allocate capital to projects that we believe in. In the same way that we vote with our wallets with everything that we buy. You can choose to buy McDonald's, or you can choose to shop at a local farm shop. When we invest, we have the opportunity to allocate our capital to things that we believe are going to be a positive influence on the world. Again, you don't have to do that. No judgment if you want to go invest in oil companies. Absolutely not. That's your decision. I don't believe it's right or wrong. But this opportunity is there to actually give it to projects that you believe in. And what's really cool right now is from my perspective anyway, a lot of the projects that could potentially have a really amazing change in the world are also becoming very profitable investments. A lot of the projects that could change the world are becoming profitable investments. The tide is turning, and we're right at an inflection point. And this is one of the reasons why I'm doing this now, because it's all becoming clear to me, and it's something that I want to share. You see the logos. These are certain things that I have either invested in or I'm an investor in. You probably notice most of them and know most of them. Bitcoin. Chainlink is a different cryptocurrency. I won't get into the details, but just so you know what it is. Gold, silver, Tesla, Spotify, Shopify. I believe crypto can really help shift the banking system and other systems. Gold and silver. Monetary policy in certain ways has been quite damaging, and going back to gold and silver could be a great thing for the world and humanity. Tesla moving away from fossil fuels. Of course, there are, with everything, there's other considerations. It's actually not that not that sustainable to build electric cars yet. So there are considerations like that. Spotify, I see that as sharing art, music, and podcasts. And Shopify is all about trying to take the power away from Amazon. That's basically their mission. And hey, I used to own Amazon shares, so I am shifting my perspective at the moment, and I sold my Amazon shares and bought Shopify shares, and they've done very well. And this is just a selection. You will find many if you choose to explore this area more. The final reason is that for people who aren't investing, essentially what they're doing in what their alternative is that they're investing in debt. And it's not even investing, it's taking on debt, whether that's mortgages or car payments, credit cards, or keeping it in cash, keeping any money that they have in cash. Both of these approaches are losing approaches. Both of those approaches are losing approaches. And I'm going to explain why. I'm sure you've all seen some sort of graphic like this before. And I'm not even going to go into the numbers because the message is probably quite clear. A small percentage of people in the world own the vast majority of the wealth. The biggest reason for this probably is not what you might see on Facebook or conspiracy theory documentaries. There are of course some negative and dark influences in the world, but the biggest reason for what I'm showing you here, the wealth divide and the growing wealth divide, is that the people at the bottom of this pyramid are not treating their money and income in the same way that the top part of the pyramid are. And that's not their fault. It's lack of education, which is why we're here. You could certainly say that there are some barriers in place to keep that lack of knowledge and education in place, and I would probably agree with that. But we can change it. Each one of us can change this, firstly for ourselves, and then, as you know, there's a ripple effect. If we start to change the situation, then our friends will ask us what we're doing and why we've got a bit more money than before. And we'll start to flatten this pyramid, because there's nothing stopping us if we start doing the right things. And of course, that's going to help us. But like I said, the ripple effect can be massive once people really understand what's going on. And we can really start to, one of my aims, I'm just exploring teaching this, is, to see actually how far I'm going to be able to spread some of this. And I'm currently exploring different ways and means of doing that, because we can make a difference to this. We know that the difference is probably not going to come from governments or the top 1%, because there are vested interests in keeping it as it is. But there's nothing stopping us from changing it. There's two main reasons why somebody who's not investing is losing. The first one is on this slide. The top 1% act in a very different way to the bottom 50%. You see the dark blue on the left. Equity, 61%, and it's 4% on the right. So equity is investing in assets, essentially. And assets over time, on average, go up in value for various reasons. Assets are productive, they add value to the world, whether that's a company or a project such as Bitcoin or something like that. They also pay cash to you through dividends. So you get cash flow from investing in equity. And I'll talk about briefly a bit later, probably, that the amount of money that governments and central banks are creating, which you may or may not have heard of. You may have heard the term quantitative easing, has a massive impact on the prices of equity. It means they go up very quickly. The other big difference, real estate, 11% left, 55% right. 55%. What that means is that the bottom 50% have more than half of their wealth in their house that they live in. That house is a mortgage for most people. that mortgage is debt. There's a perception that the way to become wealthy or to become financially free is to get on the property ladder. I'm sure we've all heard that saying. And that message is there for a reason. I was talking about the pyramid before. The top 1% and governments, they want you to do that. They want you to do it because it's debt. And they want you to take on debt because you pay interest. What tends to happen is that people see their property go up in value over time, so they feel a bit more wealthy. But if you actually do the maths, it's not going up in value much more than the interest that you have to pay over 30 years. And whatever it goes up in addition to that is eaten away over 30 years with inflation, which I'm going to show you. So it's a trap. I'm not saying don't go and buy a house. Houses are great, better than not having a house, right? But I just want you to look at the percentages. It's 11% on the left and 55% on the right. That's what's really important. The other big section on the right is durables. That's cars and TVs and PlayStations and material goods, which don't appreciate in value. In fact, they depreciate in value and don't provide you any cash, like equity potentially provide you dividends. Hopefully you can see the difference there. This is about really figuring out how we're going to allocate our capital. And when I say that, it doesn't have to be big numbers. We can start working on a pie like the one on the left with whatever disposable income you have, even if that's 50 quid a month, or the amount of money you spend in a year on wine and beer, whatever it may be. The second reason why not investing is a losing game is inflation. And if you're anything like me, you'd always heard the term inflation, and you kind of get that prices go up over time, but actually understanding what inflation is very, very important. So what this is showing is it's 1971 to it's about 2010. So it'll be even worse now. And if we say in 1971 that you had £100 in your account and you keep that until now, that will essentially be worth now in real terms about £5 maybe. I'm probably being conservative there, which is 1/20th of what it used to be. Put that another way, for what it would take you to buy £100 worth of stuff in 1971, it would now cost £2,000. That's why they call inflation the stealth tax. Because for every pound that you're holding in your bank account or under your mattress, in your purse, even in like ISA, but even in like a pension, for example, the purchasing power of all of those pounds are being eaten away quite rapidly, and more rapidly today than ever before. because of what I touched on earlier about governments printing money. And actually, you can see that on the red line. There's a direct correlation. The more currency that governments or central banks create, the less your currency is worth. If there is £1 in existence and they create another pound, the pound that I had is now only 50% of what was in existence before, and before that it was 100. And they just create it out of thin air. Every time that happens, and if you're not watching the news right now, I don't blame you, but it is happening now at unprecedented levels because of COVID. The European Central Bank just passed a bill to create €2 billion out of thin air. That means every euro in existence just decreased in value. The message here is so many people keep their cash in their bank account. Actually, it makes people feel good if they're building up their bank account.
Savers are losers.
And I understand the reasons why. We all want stability in our lives, but we need to try and shift that mindset, because you'll get 30 years down the line and you won't have gone anywhere financially. And actually, you may have gone backwards. A lot of people get to retirement and their pension is worth a hell of a lot less than they thought it would be in real terms. Maybe they've been saving towards having £500,000 in their pension because they want to do this set of things. They can't do that set of things anymore. They can only do half of them. I'm not saying we're going to have rioting and burning in the streets and lose all our money in the UK or in the Western world, but I'm also not saying it's not going to happen. What you're seeing here is a possibility. Because of what they're doing now with money printing. This is Zimbabwe and Lebanon. You may think, oh God, that's miles away. They're probably doing some weird stuff over there and, causing all this turmoil. They've just done what we're doing. And if we continue to do what we're doing, there could potentially be similar results. And what I'm trying to do today is to protect you against waking up in a year's time and that £10,000 that you've been saving because you want to put a deposit down on a house is now worth £2,000. Right. Investing misconceptions. I touched on a few of these already. So a lot of people think it's going to be super difficult. And it's just about knowing what you're doing and about having a little bit of education and being interested. That's what we're here to do today. Too risky. Oh, I could lose my money. Somebody told me that their investment went down 50%. I've just shown you how leaving your money in the bank is also risky, but even more risky because it's guaranteed to lose money. If you invest in assets, they're more likely than not, based on history, going to go up in value. If you don't invest in assets, it is guaranteed that your cash is going to go down in value. It's guaranteed if you take on debt that you're going to pay interest. You can choose safe investments. There are all types of investments available. And if you want to take on risk, that's cool. Then you might get higher returns. If you want to invest in safe stuff, then you can do that as well. So it doesn't have to be super risky. And a lot of people say only invest what you can afford to lose. I don't like that term. We're not here to lose. So only invest what you don't need in the short term. I don't have enough money. Very, very common. Very common. You only need a small amount of money. You don't need many thousands of pounds. If you have them, great, cool. If you don't have them, like I said, we all, I'm sure, spend money on frivolous things. Not a bad thing. We all want to have fun, but maybe a few beers or a bottle of wine here and there can go into actually putting your money into something that may retain its value or go up in value. It's not for the likes of me. I mix with a lot of yogis, meditation people, hippies. Very common to think that investing is for people in suits and banks and stuff like that. And it's not true. And that's one of the things that we really need to get away from. Because that's what's holding us back. Okay, done that. Investing mistakes. Be careful when you're investing, right? Anything to do with money, there's always going to be people out there trying to grab it from you, right? It's just the nature of things. So anybody that says you're going to make a shitload of money in the next 6 weeks if you invest in this thing, just be very conscious of that. Always ask questions, do your own research. Don't listen to me if I say Bitcoin's going to go up. When you start investing, you will want to check it every day to see how it's doing, potentially, but it can be quite addictive, especially if it starts going up, and hopefully it will go up. But we're not traders, like we said before. We don't want to be checking it every day. That's just going to be a lot of time, potentially stress inducing. So we don't want to watch it every day. We want to make good investments and then just let them appreciate over time. Selling when your investments go down. Selling when your investments go up. Right, so I'm gonna take you through a little example because I'm sure you'll find it interesting. What should we do? Last week I did Tesla, so I'll do Spotify, because I think we all know Spotify. Let me clean this up a little bit. You'll never need to use something as complicated like that as this, so don't worry about that. I'm just showing you because I have it handy. So imagine how long has Spotify been alive for? Not long, actually, only over a year. Imagine we did this a year ago and you saw my little Spotify logo at the beginning and you're like, oh, Chris thinks Spotify is a great investment. I'm going to go invest in it now. Very possible that might have happened. So, well, it can even do earlier this year. Let's say that this was right at the beginning of the year and you're like, right, I love Spotify. I think it's awesome. I'm going to go invest in it. Right at the turn of the year, you bought some Spotify shares. So this is about $160 per share. And another misconception I can tidy up now is if Spotify is worth $160, it doesn't mean you have to invest $160. You can invest $16. That just means you're buying 1/10 of a share in Spotify, which is very possible. But so let's say you invested $100 in Spotify. You did it here because our course was on that day. And then you looked at your account a couple of days later and it's gone down. That happens all the time. And if you're making emotional decisions and checking your account every day, you may have noticed it went down, let's say 7% overnight, and you're like, oh my God, I've lost £7 out of my £100 already. Chris is an idiot. Why did I follow his advice? It's not advice. Then what a lot of people do is sell it because they're like, I've still got 93. Don't want to lose the rest. So better get out now while I've still got 93. Well, that's with this example, you'll keep looking at it because you're still invested emotionally in Spotify, and it actually went down even more. So you've been like, right, I made a great decision now. And then you're not invested, you start watching it go up to here now. And you're like, oh no, I need to get back in because I'm missing out now. So once it gets here, you invest again, but you've only got 93 to invest because you lost 7 last time. So you invest again, and then it goes down again. And you sell again, and you buy again, you sell again. This happens all of the time, right? What I'm just showing you early is if we zoom all the way out, all that stress that you went through about trying to do all of this stuff, right, was a complete waste of time. Because if you'd have just invested where we said we were going to invest, and then you got really stressed and you kept buying and selling, etc., and you probably ended up losing 30 quid at the end of all of that. And then you probably weren't invested at the end because you were too stressed out and you gave up. If you'd have just held on to it until today, you would have made 71% on your investment. So it would be worth 171 rather than the 30 that you lost. And at some point, hey, it was up 85%. And what's crazy about this as well is this is only since April to now. It's only a couple of months. So it's been crazy returns on Spotify. So I'm even suggesting that if you would have invested here, you should be looking to hold it for 5 years, right? You're doing it because you think in 5 years, Spotify is going to be servicing everybody's music and podcast needs. And that's why I say here, a mistake is both selling when it goes down and selling when it goes up. Too much selling. All we need to do is make a decision and then leave it. Linked to that, making emotional decisions, watching the news. Maybe you saw on Facebook that Spotify signed up Kim Kardashian to do a podcast, which they actually did. And you think that's a terrible idea. But that might be an emotional decision. It doesn't really impact Spotify's business and business model. They're going to sign up many, many people to do podcasts. Watching the news, maybe you're invested in Bitcoin, and somebody tells you, or you see on the news that there was a Bitcoin scam, and you go and sell. Well, if we make too many of these emotional decisions, if we watch the news, that is a surefire way to not be a good investor. Knowing your investments and strategy, we're going to come to that, about what that might look like. The guy the guy at work told me to buy, let's say, Bank of America, for example. That's an inside joke with Joe. Yeah, make your own decisions, do your own research, figure out why you're investing in what you're investing. And we're going to come to this, not diversifying your investments, putting all of your eggs in one basket. We all know that phrase is not a good idea when you're investing. Investments can go up and down. Some investments can go to zero, right? It can happen. So you need to make sure that whatever you're investing, you're doing it in multiple things. So what might our principles look like when we're investing? We've said already, don't invest what you don't need access to. So always have 3 months of cash on hand for emergency uses. Have a long-term time horizon. It's up to you to define really what long-term time horizon means for you, but the longer the better. If your investments can be for 30 years, then that's perfect. Doesn't mean they have to. You can invest for 20 years, 10 years, 5 years, but the longer the better. And the reason is compounding returns, and I'm going to talk about that. Diversify. Some people say you should diversify up to 30 different investments. Probably a bit much for beginners. I would just like to get you started, but let's go for at least 5. More if you can, but at least 5. Define how and when you'll check. It's linked to what I was saying before about always checking your account, checking the news, etc. Maybe you choose to check once a week, once a month. Put it in your diary. That's your time, so you're not always seeing if it's gone up 1% or down 1%. A good time to do that is on a weekend, because a lot of the markets aren't open, so you can't sell stuff. So then you at least have to sleep on the decision that you're going to make. This is critical, and I'm going to come to some examples. Invest a consistent amount on a monthly basis. A lot of people come to me right now actually and say, hey, I've got $1,000 that I want to invest. Cool, that's good. But what gives you the most value and returns over time is if you can put aside money on a monthly basis. And as I said before, it doesn't need to be a lot. Could be 50 quid a month. If you do have $1,000 to invest total, let's do 100 quid a month for 10 months as a starting point, and then hopefully you've got to a stage where you can continue that. Do your own research, decide what's meaningful to you, I've talked about. And write down your principles. This is sort of my principles here. That's why I'm teaching it. Have a think. Write down what you think is going to work for you. Okay, so you're probably like, that's all well and good, a lot of theory, but what are we actually going to invest in? You know, the exciting stuff. Well, firstly, the way that we group what we can invest in is called asset classes terminology. Just means types of investment. And I've excluded from this private investments, like, you know, putting a certain amount into a private company, buying a house, buying real estate, land, art, collectibles. You know, these are big purchases that you decide or not decide to do in your life. Hopefully we get to a stage as a group where we've got loads of cash where we can do all of that stuff, but it's not what we're talking about right now. The best investment you can make is in yourself. Very important for me to say this. If there's anything that you want to do in your life, any experience that you want to have, any skills you want to acquire, any course that you want to do, and that should be the priority. And it gives the biggest return anyway. If you're a happy, well-rounded person, then you have a much greater foundation to go and do all the things that you want to do. Talked about cash. A good way of looking at this is what I'm showing here. Cash is an asset class. If you're holding cash, essentially you've decided to invest in cash. And when I say cash, that's also in your bank. It's also in an ISA. And I'm telling you that that investment you've made outside of that 3-month fund for emergencies that I talked about, if you're building loads of cash, then that is a bad investment. Bonds, I'm only going to touch on because they're not that interesting. I don't recommend that we invest in bonds. Companies make loans because they need money. Also, governments do as well. There is an opportunity to invest in funds which, for example, have the bonds of Coca-Cola, McDonald's, and Apple, and Microsoft, blah, blah, blah. It is a way that you can invest. A lot of investment professionals recommend that you do. If that is of interest to you, then go and do some research. I don't do it, so I'm not teaching it, but it's there for you if you want to go and do extra research on your own. What I care about is the bottom row. Equities is the terminology, just means shares in a company. Any publicly traded company on a stock exchange, and there are hundreds of thousands, all of the big names that you know about, and many that you don't know about. When a company goes public, it basically just means that anybody, pretty much anywhere, can buy a part of that company. And look, for most of these, you're going to be buying maybe one share out of hundreds of millions of shares. You own a tiny bit of it, but you still own some of that company. And I showed you earlier that the top 1% own equity. They own companies. They own companies outright. They also own shares in companies. And there's nothing stopping us from owning companies. You can own Amazon if you want to own Amazon. You can go right now and buy a percentage of Amazon. It'll be a tiny percentage, but you can do it. It's important that you look at it as you're now an owner of that company, because it's the truth. Most people don't really get their heads around that. Commodities. One of my 2 favorite topics at the moment, because I love gold and silver. But there is more than gold and silver. Oil, copper, zinc, nickel, soybeans, coffee, wheat, blah, 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 blah. You can almost invest in any type of commodity. Obviously, a lot of the ones I just discussed are, very specialist, and, we're probably not going to be investing in the price of coffee beans. But gold, silver, and oil are the main ones that we really have the opportunity to invest in. And that doesn't mean that you have to own gold bars like what I'm showing there. You can, absolutely, or you can own gold coins, but you can also buy shares in funds that go up in value if the price in gold goes up. And I'll go into a bit more detail about the practicalities of doing that. But if you believe that the price of gold, silver, or oil is going to go up, then we can invest in that. There's nothing stopping us. And the new kid on the block is cryptocurrency. Only been around since really about 2012, out the back of the last financial crisis. And I could do a whole couple of hours on crypto, on Bitcoin. I'm sure you've heard of Bitcoin. There are more. I've put Ethereum, Chainlink here, some of my favorites. There are actually thousands of cryptocurrencies. So without getting into too much detail, Bitcoin especially, this is a project to try and take control and power out of the current banking system, to move people and their currency out of dollars, pounds, euros, and into a digital currency. Like I said, there's thousands. And, you know, like with gold, silver, oil, like with all shares and equities, it's really up to you to go and do your research to understand what they are. But all that information is super readily available now, especially with Google. So I'm really focused on the bottom three. That's where all of my investments are. And I want to show you what those types of investments are likely to make you based on what returns they've had in the past. Cash, like I said, it's an investment. If you had, so this is based on what these assets have done over the past 30 years. When I say cash, what I'm talking about here is having a high interest savings account, which today is about 1%. So if you have put £1,000 of cash in that interest savings account today, and you go to get it out in 30 years, then you'll have £1,350. 350 quid, I wouldn't say is that great if you're going to go and get it out in 30 years. I'm not even taking into account inflation, which I talked about earlier. So essentially, you'd be very negative. The real inflation, the governments and banks like to talk about 2% inflation rate. For various reasons, that is fudged. So it's really about 4 or 5%. Essentially, if you keep your money in cash in our interest savings account, you're losing 3 or 4% every year. So that would be a negative number in real terms. Bonds, just to touch on it, they do make about 5% a year on average. If you go and get your £1,000 out of your bonds in 30 years, you've made just under 5 grand. Not bad, not great though for 30 years. UK equities, so if you can invest in a fund, for example, that tracks the top 100 companies in the UK. That would be, I don't know a lot of them. I'm not that interested in UK equities, but I think it'd be like Pfizer and AstraZeneca, Barclays, etc. That's on average achieved 7% a year. And therefore your £1,000 in 30 years would be worth £8,000. We're going in the right direction, but we'd still like to make more. US equities is just very similar. Coca-Cola, McDonald's, etc., etc. You get a bit more, 11,000. And just to note that here, all I'm talking about is putting in £1,000 and going and getting it out in 30 years. If you're investing regularly, like we want to, then obviously we'll make a lot more. And I'm going to show you that in a second. Gold's average return has been 10% over the past 30 years. So your £1,000 has now gone up 20 times. Pretty good, actually. Definitely better than cash. Silver has been 12%. Your £1,000 is now £36,000. And finally, Bitcoin. Before I pull up the numbers, I've based this on 10 years rather than 30 years because I won't be able to fit the numbers on the screen. And I'm going to set you all a little challenge. And the winner gets £25 in Bitcoin. I want you to be ready at your keyboards, if possible. I know Britt is out walking. So, if you invest £1,000 in Bitcoin today, based on what it's done in the past, how much money is that in 10 years? You have 15 seconds to put it in the chat. The closest wins £25 in Bitcoin. Go. No Googling. You won't be able to find it in 15 seconds anyway. It's too complicated. This is a value, not the percent, the pounds amount. 5 more seconds. And then I'm going to check. Okay. Submissions are closed. I'll show you the answer and then I'll go and check. I can't see the chat whilst I'm on full screen here. So I'm excited to see who won. But if you invested £1,000 today in Bitcoin in 10 years, based on what it did in the past, that doesn't mean it's going to do it in the future. Don't go out and put all of your money in Bitcoin straight away when you see this. You'd have £3 million in 10 years, not even 30 years, in 10 years. Because Bitcoin's historical return has been 83% per year. And that goes up very, very quickly over time. All right, how do I get my chat? Here we go. Okay. I have some funny private messages here. Thank you, everybody. I'll have to come back to some of those messages. Okay, right. So we have 300,000. Robin, 2 million. That is close, actually. Joe, 1 million. 100 million. Binny and Chris, 3.5 million, which is the winner. That's amazing. Well done. So there's 2 of them on here as well, so they'll get £12.50 each in Bitcoin. And I'll help you set up your wallet and stuff if you don't know how and don't have one already. So well done. Hope you all enjoyed that. Oops. And look, it's a massive number, obviously. And I'm not saying that it will happen in the future. It's only what's happened in the past. But they say that history doesn't repeat itself, but it rhymes. So you're certainly more likely to make £3 million investing in Bitcoin than you are in keeping your money in cash. I can say that for certain. And the reason why these numbers go up so dramatically is compounding returns. This chart is actually very simple, even though it might look a bit complicated. So this is based on if you made 8% per year, which was actually the US equities return. On the green line, what you can see is somebody that between the ages of 21 and 41 invested $24,000. And that was it. That's all they invested. The power of compounding returns means that every year they make 8%, but that 8% is being made on a bigger number. That 8% is being made on a bigger number. So what that does over time is it creates this exponential curve that you can see, which is the green dotted line. And this relates back to what I was saying about having a long-term time horizon. If you were to invest £24,000 between the ages of 21 and 41, I know some of us are not 21 anymore, but some of us are actually. But however old we are, what the message here is about getting started as soon as possible. £24,000 invested at that stage would mean by I think that says 67. You'd have £500,000 from £24,000. And you can compare that to the person that invested £24,000 between the ages of 47 and 67, because that £24,000 became £60,000. Hey, that's not bad. That still means that it was good for them to invest. But you can see the difference. And we don't want to wait longer than we have to. because then we don't get to benefit from the exponential part of the curve. How do we actually invest? Like, okay, cool, we've talked about the different things we can invest in, talked about what it might make, but now you want to go ahead and actually make some investments. And I talked about diversifying and not putting everything into one basket, and I've talked about the different asset classes. That means when you start to invest in multiple things, you create a portfolio. Fancy word, just means that you've got multiple investments. And it's up to you how you structure that. The way that you structure that will determine how risky it is and what your potential returns are. So the big differences here is when we talk about higher risk, equities are generally known as higher risk because they're companies. Companies can do well, they can do poorly. I showed you Spotify. Spotify might turn around tomorrow and have lots of fraud and go out of business, right? It happens. It's happened to companies before. So companies can go down and they can go out of business, and the economy can collapse and all the companies can go down in value. So equities are known as slightly higher risk than, for example, bonds. You can see in the medium and low risk that there are bonds involved. They're very low risk because usually you invest in bonds of big companies like Coca-Cola, Microsoft, etc., and they're not likely to go out of business. But also governments are not likely to go out of business or default. Also, in the higher risk portfolio, you can see a bigger allocation to cryptocurrency. Yes, you could make £3 million in cryptocurrency, but it's also very high risk. It's only been around for 8 years, and it could easily go to zero. Things that have not been around for very long are more likely to go to zero. So a low risk portfolio, which you might invest in if you're older, or just you don't want to take on risk, you will probably not invest in cryptocurrency. And then gold and silver is also known as very safe. And that's the reason being that gold and silver has been around since the beginning of man, and has had a value since the beginning. So a lower risk portfolio would have more gold and silver. Generally, the lower risk portfolio, the lower returns you're going to get. And these are estimated, what I've put down here, 10%, 10%, 15%. Any of those would be good. We showed what 8% per year did here. If you're getting 8% per year, that's a hell of a lot more than you're getting in cash. I've just talked to you about compounding returns. If you were to invest £1,000 today and then £100 per month for 30 years, which may be possible for you right now, it may not. You may not have £1,000 to invest right now. That's no problem. If you still invest £100 a month from now, you're still going to get pretty much all of these returns. If you can invest £50 a month from now, you're going to get half of what I'm about to show you, which is still a hell of a lot. On the lowest risk portfolio, if you did what I just talked about, after 30 years, you'd have £130,000. That's quite a good amount of money. And maybe you have a bit more. Maybe you have £2,000 to invest and £200 a month. Well, just double it. 260,000, £250,000 if you invest £200 a month. £100 a month and you get 10% a year. After 30 years, you have £250,000. Again, I like to double it. If you can get to £200 a month, you get £500,000. If you earn 15% a year, on £100 a month, then after 30 years, you have £750,000. That's quite financially freeing, I would say. Again, maybe at some point you can get up to £200 a month. You're looking at 1.5 million. Maybe at some point you do well in your job, you're a good saver, you can invest £400 a month. If you were to do that, after 30 years, you would have £3 million. That's the power of both investing monthly and having a long-term time horizon. I thought long and hard about what to put on here. But I like to be very transparent. And I think it's going to be very interesting, but it's very important that I just say again that nothing I say about what I do is a recommendation that you should do. If I've done well out of this, it doesn't mean that this is going to do well for the next 6 months or a year. So I base my investments on a couple of principles, or my thesis. Talked about governments and banks printing ungodly amounts of money, which is already leading to inflation. And that is only going to get worse. Trust in governments is deteriorating. You might also say trust in currency is deteriorating. We're in a global recession. How bad is it going to get? Is there going to be a second wave? How many bankruptcies? What's unemployment going to look like? On the positive side, I believe in technology. I believe in innovation. I think it can have a really, really positive impact on the world. And like I talked about, I used to own Amazon, and then I switched to Shopify. And I don't actually own Shopify anymore, but I used to. I want to find meaningful projects for me, because actually it makes me feel good to see what they're doing, and to know that my contribution to them is benefiting them. If you invest in Shopify, for example, however much money you put in, then the value of that company is going up. That means that company is being more successful and can do more things. They can invest more in R&D, in marketing, get their product out there. More people become aware of what they're doing, even if you're investing in a very small amount. And for example, with Bitcoin, every pound I take from my bank and put in Bitcoin, I'm taking that out of the current banking system and into the new financially freeing system, from my perspective. This is very specific to me and will be very different to you. And that's why I'm not sure. I wasn't sure whether to put it out, because it's like, okay, now let's try and figure out what he's doing and copy it, right? So don't do that. It's very specific to me. I'm investing a lot in gold and silver mining companies. They're the companies that go and get the gold and silver out of the ground. I would like to see us change the monetary system and go back to a gold and silver backed standard. That's very personal and meaningful to me. May not mean anything to you. But I also am aware that with inflation, gold and silver has been a very safe store of value in the past. And actually, if you look at a very simple chart, gold and silver usually goes up a lot during a recession and after a recession. And when it does, the value of gold and silver mining companies goes up a lot. But very specific to me. Okay. Cryptocurrency. No financial advisor would recommend that you have 1/3 of your investments in cryptocurrency, but I really believe in it, both from a project perspective and the return perspective. And I could be super wrong. I might lose 30% of my investments. However, that's my choice. Technology companies, I showed you a few logos at the beginning. I do like technology companies. I think they can be very powerful if used the right way. I wouldn't invest in Facebook, but I also don't judge at all. It's up to you to figure out what you want to invest in. Trading, you won't be doing, at least for a couple of years. Maybe you'll get super interested in all of this and decide you want to start trading. I do some of that, but it's not really for you to worry about. That 10% you can put in long-term investments. And cash, I try to keep to a minimum. It varies. At some point a few weeks ago, I had £18 in my bank account. Yeah, I'm managing that very carefully, obviously, but it's because I want to put all of my pounds to work with my investments. And I know every day it's in cash, it's going down, like I talked about before. Do make sure that you keep enough cash on hand for your life and for emergencies. Very, very important. Things can change very quickly. And, I talked about high risk, medium risk, lower risk. You would most certainly define my investments as very, very, very high risk. But that's my personal choice. And that's why I was a bit hesitant about showing specifics, but hopefully it's interesting. You're probably saying, great, that's all really interesting, I want to get going. So how do you actually do that? Number one, like I said at the beginning, this is really a intro. Hopefully I'm showing you that it's not that complicated once you learn a bit about it and some of the terms. But of course, there's more to learn. So I'll be sending you this webinar and the slides, but also get on Google, get on YouTube, have a look for the investing books, etc., etc. Get more comfortable with anything that's come up that you have questions about. Write down your principles I talked about earlier, your strategy, how much you're going to invest, how are you going to check your account, what's meaningful to you, etc., etc. Set up your investment account. I'm going to show you what I use next. But look, we hold our investments somewhere, and they're not that complicated. It's quite easy. I'm sure with the average age of this group, we're all very used to setting up accounts on the internet. It's no different. It's very, very simple. Merge your ISA and your investment account. This is quite important, especially if you are a UK citizen. We can put £20,000 a year into our ISA. Most people put that into our high interest ISA because that's the message that probably some people want to give you, and that's not what we should be doing. You can invest within your ISA, and in fact, that's exactly what you should be doing. You should be investing within your ISA. So you want to set up a stocks and shares ISA if you don't already have one. You can put in £20,000 a year. Any gains that you make within that ISA are completely tax-free. There's no capital gains tax. And you can invest £20,000 a year. So you may not be able to max that out at the beginning, but that's actually a hell of a lot to be investing on a yearly basis. So you can probably do most of it in there, if not all of it. Any existing ISA that you have is usually quite easy to move over. You'll just need to check with who you set up your investment account with, but they want you to move it over because they want the business. It's usually there, it's usually simple, just a form that you need to fill in. Usually that means that, you know, if you've been building up a certain amount of cash in your ISA, then you just fill out the right form and go through the process, and you can have that appear in your investment account in your stocks and shares ISA, which is usually a very good starting point. If you don't invest for your ISA, you pay capital gains tax when you sell any of your investments. Explore and find your investment. I've given you some breadcrumbs, given you some specific examples, but it's really up to you to go and have a look around, start exploring. I'm going to show you on the next slides how you might begin to do that. But really the opportunities are endless. So enjoy going and exploring. I've talked about the impact of monthly investments, and it's really important. So when you set up your investment account, if you do it through the one I recommend, but there are also others, you can set it up with them. So you say, I want you to take £100 a month from my bank account, direct debit, and I want you to invest in these 4 things. And then it'll take that 100, it'll put 25 in each of the 4 investments. For example, it can be any number or split that you want. And that means that once you've figured that out, what number that's going to be and what it's going into, you don't need to touch it. Probably the next time you touch it is when you put it up to 200. And when you're ready, and only when you're ready, then take the plunge and enjoy it. Stick to the sort of principles that I've talked about. Write down your own principles. Probably should write on here again, know that your investments can go up and down, and they absolutely will. You may start investing and the second wave of COVID happens and everything goes down by 50%. It can happen. That's one of the reasons why we do it monthly, because you don't put it all in one go and then it goes down a lot. If you put it in over a year, 2 years, 5 years, and even if it's going up and down, you're averaging in, it's called. Just means that the price that you're paying is an average. So when it goes down, it'll be low. When it goes high, it'll be high. This looks a bit complicated. Let me just explain. It's not that complicated. You can buy physical gold and silver if you want. I actually I have a silver coin here that I bought, pure silver. It's actually very easy to buy physical gold and silver. I use royalmint.com. Very trusted. It's kind of the home for UK minting of precious metals. And very easy to buy. If you want to buy shitloads from them, you can, and they'll even store it in a vault for you. Or you can buy small amounts and get it delivered. But it's very easy to do. Now, you don't have to do that. You can benefit from the gold and silver price going up in other ways. In terms of the gold and silver price, so let's take the gold price, for example. I'm saying here SGLN fund. That's the sort of thing that looks complicated and starts worrying people. It's not that complicated. SGLN is just basically the code. And what that's a code for is a fund that you can buy shares of that tracks the gold price. So if you see the gold's gone up 5%, this fund that you bought £100 of will have gone up to £105, but also the same if it goes down 5%. And that's the same for all of these. So I put the gold and silver miners in there because I had to, because that's what I'm invested in. These track the GDX fund, for example, that tracks the performance of all of the gold miners, basically all of the big ones. So if in general they all go up, then the value of this fund goes up. Same with UK equities. It will track like the top 100 companies in the UK. US equities, like the top 500 companies in the US. Global equities, it'll just be a combination of many, many companies around the world. Basically, if you think that business is going to get exponentially good around the world, you may choose to invest in that. Technology equities, you believe that in general technology is a force for good and powerful and adding shitloads of value to the world, you can invest in a fund that tracks the performance of a basket of technology companies. So they're all funds, right? And I do that through hl.co.uk, which is Hargreaves Lansdown. And they make it very easy for you to put your ISA in as well. They make it very easy for you to do your monthly investments, which is why I recommend them. Individual equities, individual companies. These are the codes for Tesla, Spotify, Shopify. Hopefully that's pretty obvious. Every investment has a code. You don't even need to know it, right? If you go on Hargreaves Lansdown or similar and you write Spotify, Spotify will come up. If you write in gold, then a list of gold funds will come up and you can have a look through them. I've just pulled some examples for you. That's really for you to go and explore, because I can't tell you exactly what to invest in. Bonds is an example there for you to look at. I'm not interested in bonds. Cryptocurrency is a different way of doing that. The main platform for cryptocurrency is Coinbase. It's the most mainstream, it's the most secure. This is still a very immature market, so I would recommend Coinbase. But Coinbase is very safe. Within Coinbase, you'll see there's about 20 cryptocurrencies on Coinbase. Obviously, Bitcoin is the main one. Ethereum is number 2. Chainlink is one I like for you to have a look at. But still within Coinbase, it's not too dissimilar to Hargreaves Lansdown. The best thing about Coinbase is that you can set your monthly investment. If you want to invest £20 a month in Bitcoin, you can go onto Coinbase and put that in. It's super user friendly. They've got an app as well, and you set up a recurring investment for £20. And again, it'll grab that £20 from your bank and buy Bitcoin at that date every month or every week. It's up to you. Okay. That last slide is meant to be a teaser because it's now really up to you to go and have a look around, to explore, to learn more. It's a jumping off point for you. I'm figuring out where to take this course next because I do recognize this is not the full picture. You know, quite a few people from last week now want support actually setting up their investments, right? So I recognize this doesn't give you everything that you need, but I'm going to send out a survey so you can give me a feedback, and I'm either going to do more webinars. I might do record a course. I don't know yet. The options are endless. I want to figure out what I can do to add the most value. Hopefully what I managed to do is show you that it's not super complicated and that it's quite interesting. I hope that's what you took from it. Maybe you still think it's super boring. And I guess just as importantly is show you how important it is in terms of what the impact is if you don't do this. Certainly a negative financially. And if you do it, and of course only do it if you want to and you find it interesting, but if that is the case, then it can be very empowering. It can protect you. It can also be very financially freeing. And with that, that is the end of the content. Thank you for the round of applause that I can't hear. But I'm going to hear it soon because I'm going to ask. Oh, where have you gone? There you are. I'm going to. How do I unmute? Don't know. I'm going to unmute you all just so we can have a little Q&A. You don't have to ask any questions. But I'm here. Please ask away if there's anything else that you would like to know at this point.
Hey.
Hey, Robin.
That was amazing. Thank you. Something that I'm definitely wary of, and I think like just from knowing very little, yes, okay, I'd like to invest in silver, let's say. How do you know that that company is mining for silver, if that's what you call it, in a conscious way, and that the whole chain of it is positive and not damaging anyone?
It's a great question. Doesn't surprise me that it comes from you. So the answer to your specific scenario is that it isn't, because mining companies use a lot of fossil fuels to get the metals out of the ground.
Mm-hmm.
And that is a fact of the current energy system. So you may just stop at that point and say, hey, I'm not interested. Okay. Maybe you're okay with that. And maybe you want to learn more about where they're situated. Like a lot of them are in Africa, for example, and you want to learn about the specific company. It's really a Google exercise.
Okay.
There is a lot of information out there, and you can go as deep as you want to go and read all of their reports and read what journalists are saying about them and stuff like that. But that's also, if we talk about specific companies, which for a beginner, certainly, you wouldn't invest in a individual silver mining company. It is too specific. If you were going to invest in silver mining, you would do one of the things I talked about, which is buy a fund that tracks the performance of all of the silver mining companies. So really, you kind of have to make a personal judgment call on whether you're happy with how they get it out of the ground from an energy perspective, and as an industry, are they probably doing good ethically or not? And that's your decision to make. And you may say no. And you know, if you're super conscious, like extremely conscious about that stuff, I don't blame you. That's a good thing. It will limit what you want to invest in, but it doesn't certainly doesn't limit it. There are still good investments. You can go invest in Bitcoin straight away, right? Or in other cryptocurrencies. There is very little, unless you go to very specific companies who are perhaps doing some fraud, but you know, in general, crypto is all about taking power and decentralizing it. You may just buy gold and silver because you may say it's already out of the ground. So even if it wasn't done ethically, it may or may not have been, well, it exists now. So I can buy something that's already out of the ground, and whatever's happened in the past has happened. And then you might want to get super specific. And there are many companies that, public companies that are about clean energy, solar power. There are even funds around, there are green funds that only invest in sustainable companies. And that's about you going to explore. And look, Google is your best friend as a starting point.
Thank you.
Chris, that was, I don't know if I can ask you a question, but that was
Yeah,
incredible.
absolutely. Thanks, Leo.
I enjoyed some of it from the comfort of the bathtub. That was very nice. So I had to miss some of it. So I'm looking forward to catching up with the link. So if I do ask you a question, which I did write in the chat box, if you did cover it, then stop me, obviously, as soon as you want. I guess if I had to choose one of the questions I asked, it would be, to what extent do you research a company that you're thinking of investing in? And do you have any tips for us to go through? For instance, I guess one side of researching would be exploring the annual statements. I don't know, maybe 5 years of annual statements, and how do you browse those hundreds of pages?
Yeah, again, great question. And you can go super deep if you choose to. So let's say if you wanted to invest in a single company, like a Spotify, one of my favorite examples. Yes, absolutely. You can go on their website, investor relations. You can pull out every annual report, which is hundreds of pages. They also do quarterly reports. So that would actually be 5 a year times hundreds of pages with all of their numbers, but also loads of commentary. And you could spend a year trying to understand Spotify inside and out. No idea. Personally, and again, I'm not a beginner at this point, so it may be different to you. I do a bit. If you go on a website like investing.com and put in Spotify and click financials, then they just give a very quick summary where you can basically see like profit, costs, revenue, etc. So I do have a quick look at that. I don't like do any spreadsheets or calculations or anything, right? I'm just the actual thing that one of the main things that I'm looking at is whether they have loads of debt. Because from what I've just talked about, if you have loads of debt, you're not in a great place. So I have a quick look at that. I see if they're making profit, and then I go, do I believe in Spotify? Do I think that the fact that they just signed Joe Rogan is a good thing? Do I think that more and more people are going to be downloading the app because of COVID and we're spending more time on our phones, we're getting a bit bored? Do I think that their technology is slick? Did a little Google search. Oh, they're now finding new ways to add in video. Great, looks like they're cool and innovative. And that is enough for me, actually. Because you can, like I said, you can research all day long, but there's diminishing returns with that research. So you need to get to a place where you're comfortable.
Yeah, thanks, man.
And again, just so another point on that is, investing in just Spotify is risky because you may get it wrong, and Spotify could tank, go to nothing. It happens. You can invest in a fund of technology companies, which is less risky. And that's really a personal preference, because then if Spotify goes down, the rest do fine. But the trade-off is you're probably investing in Facebook at the same time. So again, it's a personal decision.
Amazing. And if I may, just
yeah, let's do them. Yeah.
Our question would be, which I didn't write down in the chat box. It's essentially this idea of, which makes sense, right? Is to buy a stock at the right price. So there's different investors going about it in different ways. How do you go about? What kind of calculations do you go through to decide at what point, I don't know, Spotify, Shopify, or Silver is worth buying?
I don't really want you to think about that if we're talking about beginner investing, because of our time horizon. With this course, I can teach a more advanced course around valuations and ratios and stuff. look, Spotify has gone up a lot. And I showed you the chart, right? It's gone up a lot this year. But if I invest in Spotify, then I'm investing in it for the next 10, 20 years. So the last 3 months, even if it's gone up a lot, is not a key consideration. And if it goes down the next day and I invest at the top, it's not the top. I actually showed you the example. It went down a lot and then we held on and it went up, right? So again, you can paralyze yourself with trying to find the right price, and probably the time overall, the time that you spend trying to break down the valuation, the price, means that you're not invested in the market. So you're losing by not being invested. So that's the trade-off for me. I'd just like to see you investing earlier.
Okay.
And it's simpler that way.
Yeah, thanks, man. That's really helpful.
Okay. I'll cover your other question. You know, do you wait for a company to have been on the stock market for a few years? Do you follow startups, buy an IPO? Again, no. I'm looking for things that I believe in. If it's, you know, I knew that Beyond Meat was doing an IPO because I eat it. So it was kind of, probably on my timeline somewhere, and it came up, right? Yeah. So from that example, I didn't buy Beyond Meat, but maybe I would have just bought it the day it came onto the market. But that's just because it's in my awareness, right? I don't track which companies are going onto the market. Again, that's quite a specific strategy. I don't have actually the experience or knowledge about trying to time IPOs. That's a whole new course, which I actually wouldn't be able to teach because I don't do it.
Thanks.
What do you think of Warren Buffett's idea of only investing in things that you can predict can stay alive? Chewing gum, Spotify, etc. I think that's a really good idea. I wouldn't invest in something which I didn't think was going to stay alive. But the types of things which are going to stay alive are subjective. If you believe Spotify is going to become the predominant way of sharing music and podcasts, and that market is going to exponentially grow, then you bet on Spotify being a major part of that for the next decade or two. Yeah, absolutely. Don't invest in a company that you think might die tomorrow. But Tesla, you're betting on Tesla taking market share from Ford and Toyota. If they do that, then they're going to be around for 20 years because Ford's been around for 80 years, 100 years. I'm not really sure. If you think that Tesla can't do that, then you shouldn't be investing it.
Yeah, that makes sense. Thanks.
What would you do if you could only invest £100 a month? Tesla, Amazon, beyond that sort of budget, would you? Yeah, absolutely. I'd be buying funds rather than specific stocks because you're probably going to put all of your £100 into one stock and then it's high risk. So to diversify, you automatically diversify if you buy a fund because you're investing, or if you invest £100 in a fund, that I'm going to make the example easy, that tracks the top 100 companies, it's just putting up £1 in all of those companies when you put the money in, right? So you're diversifying 100 times. If you gave me £100 a month right now, I'd put it in Bitcoin.
Cool.
But that's high risk and not diversifying.
Hey Chris, I got a question.
Yes, Sam.
So how do you know when to get out or to sell? Because is it not a little bit like people who have the same lottery numbers? They just got to keep going, and then you like, oh damn, I pulled all my money out of this, and now I would have been a millionaire if I'd have stayed another 10 years. How do you know when to get out?
Yeah, I mean, there's a question that was asked last week as well.
Or move, not get out, maybe move.
No, I think there's an important point actually, which I should probably include in the presentation, which is making money for the sake of it is not fun, right? We make money actually to use it to add value to our lives and to have experiences and look after our families or buy houses or whatever, right? So absolutely, we have to sell at some point. Talk about holding it for 30 years, 20 years, but we have to sell at some point. It's sort of similar to Leo's question about timing, and the answer is don't time it. Don't time it. Have a long-term time horizon. Invest on a consistent basis. And when you need, I mean, that chart was $500,000, right?
Yeah.
At some point, you're going to need 50 grand to pay for one of your children's weddings. Isn't it a random example?
Yeah.
You need to sell some investments. And you would, if you had 10 investments, look, an easy way to look at it is you just get £5,000 from each. You may have a personal opinion on what's doing well and not doing well and then change that, but you shouldn't overthink trying to sell the top and buy the bottom, because it's a losing game. Invest regularly. When you need money out to do life things, you pull it out and you continue with your monthly investment.
Oh, I see. So when you take stuff out, you wouldn't take it out of one. You take it out a little bit out of all of them, possibly.
Possibly. It depends on the situation at the time.
Yeah. Okay, no, that makes sense. That makes more sense. Okay, yeah.
It's like, look, if you're investing in 10 things and you love them all, you want to stay invested in them, and they're all worth £50,000 each, just get £10,000 from each, and then you keep 40 in each.
Okay, that makes sense. Thank you, man. I really enjoyed it. It was really good.
Good. Is there any final questions before we bow out? No.
An exclamation, it was amazing indeed. It was incredible. Loved it.
Thank you all for joining. I'll be recording, so thank you to everybody who had to drop off. I know it ran longer than scheduled, so thank you so much.
Thanks, Chris.
Good luck. I'll speak to you soon. Lots of love.
Thanks, Chris.
Bye bye.
Thank you, mate.